What is the role of a portfolio manager? Let's get into that topic right now, and let's make sure we're making a difference between a portfolio manager that runs, let's say, a hedge fund or a mutual fund or an ETF, and a portfolio manager that works as a fiduciary to manage and be a custodian of a regular Canadian, an individual, his assets, his or her assets. Today we're talking about a portfolio manager that acts as an investment advisor, as a fiduciary, has a fiduciary obligation to that client, can act on a discretionary basis to buy and sell securities, build the portfolio. We're going to talk about all the different aspects that a portfolio manager does for you and should be doing for you. And I'm going to hammer out 14 things today, okay? 14 things that we're going to talk about a portfolio manager that does, should be doing for you. And if you're not getting these 14 things, go to speaktorob.com to book your no obligation consultation to chat with us about how me as a portfolio manager could help you when it comes to this. First off, investment selection. So this is picking the individual securities, stocks, bonds, ETFs, alternatives, limited partnerships, everything that goes into your portfolio, the actual selection of the investment. So that should be, a portion of it should be stock, stock selection, stock security, and a portion of it should be bond or fixed income security selection, and a portion should be alternative, either limited partnership or fund or portfolio selection. So for each of the different asset classes that you own, your portfolio manager will do the investment selection. Number two, set the strategic asset allocation. All right, so should you be a 60-10-30 client? Should you be a 80-0-20 client? That would be more aggressive. So the first number was your stocks, the second number is your fixed income, the third number is your alternatives. So a client who's, let's say, 20-40-40 would have 20% stocks, 40% fixed, 40% alternatives. That would be a fairly defensive portfolio. A client who's got an 80-0-20 asset allocation would be 80% stocks, 0% fixed income, 20% alternatives. That would be a more aggressive portfolio. The most aggressive portfolio you could have would be 100-0-0, all in stocks, perhaps some speculative stuff in there, and the more conservative would be 0-100-0, all in fixed income or cash-like equivalents. Anything in between there, your portfolio manager is deciding for you, helping you decide, making a recommendation as to what the asset allocation should be. Now that should be based on your investment horizon, your risk tolerance, your liquidity needs, and a whole bunch of other factors about you personally. This should be different than the individual in Saskatoon, the guy in Halifax, the gal in Toronto. Everyone should have their own custom asset allocation. And how is that decided? 3, determine your client's risk tolerance. This is not as simple as just putting a questionnaire in front of you or just saying, do you like it when your portfolio is down 20%? It's a lot more complicated than that. Risk tolerance is a few different things. The likelihood of volatility happening in your portfolio versus the likelihood of complete loss. Those are two different things, and a portfolio manager should be in a position to explain to you that difference. Should be in a position to explain to you the difference between a complete loss, right? So that's real risk of a loss, an asset going to zero, and volatility in your portfolio, volatility in an asset class. We know that if you own stocks, we know there's going to be periods where they're down 20, 30, 40%. We know a 30% correction will happen every market cycle, whether it's 3, 4, 5 years. And we know that every year there's likely going to be a 5 or 10% market correction. So, is that risk or is that more volatility? So determining your risk tolerance is an important part of our job as portfolio managers. Number 4, educate clients. I'm a big believer in this. I believe there should be a constant stream of education coming towards you. Whether you want it or not, that's fine, but at a minimum, we should be able to put information in front of our clients to educate them about what they own, why they own it, why they're paying, what their returns have been. Are there going to be changes in the asset allocation, in the individual stock selection? All of that are important things when it comes to your portfolio. I believe a big part of educating the client is to make sure that we're open and transparent about what we're doing. A lot of individuals are not open. They're not transparent. So if you don't know what you own, what your returns are, what your fees are, what your asset allocation is, that's probably a pretty big red flag. And I believe it's a big part of what we do is to educate clients. Number 5, manage and minimize risk. Managing that risk, first off, is understanding what it means, and then minimizing it is ensuring that you have diversification, you have assets that are uncorrelated one with another. A true portfolio that's really been minimized on the risk front will have the least amount of volatility for the returns that we're able to generate, or vice versa, the highest returns for the volatility that we're taking. Risk, volatility, not the same thing, but if someone's properly managing and looking after your risk and protecting your capital, that's a win. Number 6, rebalance that portfolio. A portfolio manager needs to be aware of any drift that's happening inside your asset allocation and then needs to be deciding whether or not they're going to make adjustments to that drift. Let's say you're supposed to be 50% stocks and the markets have rallied and you're up to 52, 53, 55%. Do you automatically trim? Do you let that run a bit? Is there a certain window, a target window that you like to own maybe a little bit more stock? What's your range that you're comfortable as a portfolio manager and more importantly as a client in owning before the portfolio rebalances? Good portfolio managers should be rebalancing on a regular basis because that's what allows you to take advantage of market inaccuracies or instabilities. When the stocks get crushed and they're down quite a bit and you now have less stocks than you used to, it's a great opportunity for you to be selling fixed income or alternatives and adding to that stock portfolio so you can benefit from the recovery. That's what proper rebalancing does. And it doesn't need to be emotional. In fact, it shouldn't be emotional. It should be mostly logically based on logic, numbers, or drift from the portfolio. Number 7, research. And that doesn't mean necessarily doing all the research, but at a minimum, they should have a reliable source of research that they can access to. They should be able to speak to various research analysts in different sectors, whether at their own firm or perhaps a third-party group that provides them with that research. They should be able to read that, digest it, summarize it, and then make decisions based on that. So the research is an important component of every portfolio manager's book, right? They need to be able to make those decisions. They need to be able to have that information, take it, digest it, and then implement based on that research. Number 8, listen to the client and understand the client's needs and objectives. If you're not listening to the client, if you're not having that regular discussion or at least that open dialogue of conversation with your client about what their needs are, what their objectives are, you're not doing your job as your portfolio manager. You need to be listening to the client. If the client is telling you, I'm not comfortable with this, portfolio manager needs to be acting. It's irrelevant what the portfolio manager thinks is potentially the best outcome for the client. The emotions are a big part of this, and you need to be listening to your client. If the client can't handle the volatility, if the client is telling you it's too much for me, I'm losing sleep, I can't do it anymore, portfolio manager needs to take action. And that's a big part of our job, is understanding the client's needs, their objectives, and listening to the client. Number 9, explain the results and the returns. This is part of kind of the review process, and it's an important piece. And when you're explaining those results and those returns, you need to be putting them in terms that the client can understand. That means percentages. You made 9% last year, Mr. Client, and put it in those terms, per quarter, per year, a 5-year number. Those numbers need to be clear for you. If you don't know how much money you're making, if you don't understand, if your advisor or your portfolio manager is not able to give you those facts, those numbers in concrete, clear, understandable language, you have a problem. That's a bit of a red flag there. So our job is to explain the results, explain the returns, and make sure that our clients understand them. Number 10, manage expectations. All right, this is a big piece of it because clients will come to us sometimes, they'll say, I've heard of a buddy, a friend, a cousin who made 20, 30, 40%. I want to make that. I don't want to take any more risk. I want to be able to do it. And our job as portfolio managers and custodians and stewards of our clients' wealth is to make sure that the expectations are clear. The expectations with respect to the portfolio are clear. The volatility expectations, the return expectations, the tax implications, all of these should be clear for the client. It shouldn't come to a big surprise to the client at the end of the year when there's a specific asset that's either down or up or had a tax impact. These need to be clear for the client, and it's your job, it's my job as a portfolio manager to make sure that the client understands that. We're managing expectations, we're setting expectations for returns, and inside of each different piece of assets, whether it's stocks, whether it's fixed income or alternatives, we need to make sure that we're setting expectations for returns in each of those. Now, bonds, obviously, the expectations will be lower returns, lower volatility. Alternatives, more tax efficient returns, slightly less return and less liquidity, less volatility. And then stocks, you got your bigger swinging assets, big swings, bigger returns, more volatility. So that should be a discussion that every portfolio manager is having with clients. Number 11, implement tax strategies. This is important because as a portfolio manager, it's our job to understand which accounts are taxable, which ones aren't, and to make sure we have a strategy in place to reduce the tax burden on our client. It's great if you make $1,000 of income, but if you have to give half of it to the government in tax, is that good? Maybe, but maybe there's a better alternative. Maybe there's a better alternative that maybe pays $800-900 and is completely tax-free. Well, let's explore that so the end client can have a lot more dollars after tax in their pockets. That's what a lot of portfolio managers, in my opinion, are not doing. They're agnostic to tax. They think that's not my problem. I'll let the accountant deal with that. Who cares? The client can deal with that afterwards. But in reality, it should matter because the taxes matter for your client. they're gonna have to cut a check in April or May when their taxes are filed. And if you've made a lot of gains, but the client's gotta pay a lot of taxes, you're not better off. The most tax efficient investments should be in the non-registered or the corporate account. The least tax efficient should go in the RSP. The investments with the most growth should go in the tax-free savings account. These are kind of basics of investment portfolio theory that portfolio managers should be implementing, and yet we don't see it. Number 12, emotional support. An important part of what we do is managing emotions. Managing emotions, or even better, removing emotions from the process. When we talk about how much it hurts for a client to be down, right? To be down in what we're doing for that. What are we doing? How are we managing emotions here? Well, we're focusing on what we can control. As a good portfolio manager, you should be repeating to your client, we are focusing on what we can control here. Happy with the assets we own today at today's price. If not, let's make some changes. But the outside events, the euphoria or the panic of the stock market, that's got to be explained to the client. We got to manage those emotions for the client. And we have to do our best to remove emotion from our process and from the discussion we're having with our clients. And lastly, number 13, retirement planning and planning advice. Now, there's a lot that can go into retirement planning. It comes with financial planning, philanthropy, cash management, insurance, wealth transfer, investment management, legacy planning, succession planning, insurance planning. All of that is kind of retirement planning. But in a nutshell here, your portfolio manager should either be doing all of that for you or should have a partner on his team, his or her team, that can provide you with that advice. If you're with a portfolio manager, you're paying a lot of fees and you're not getting that financial planning advice, that's a big red flag, all right? You need to be content and happy. You need to know where your retirement is going. You need to know how you're going to get there, and you need to know what plans in place for you to get there. Where are you going to draw down the money in your retirement? Do you know? Do you know if you're going to pull out from your RSP first or your TFSA or maybe the corporate account? Do you know what the tax implications are of income splitting in retirement? As your portfolio manager or your retirement planning expert taking care of this for you? Has this been explained? Has this been documented? Do you have a copy of that document? If not, probably time for you to book a no obligation consultation. Go to speaktorob.com. We'd love to chat with you about this, about how our team approaches it. I'm the portfolio manager. We bring in Adam Buss, who's head of wealth and estate planning, and he looks at nothing but your financial plan, your corporate planning, your tax situation, your retirement cash flow, all of that. My passion, my focus on the investment side, his focus, the retirement planning side. Give us a chance, guys. Don't hesitate. Go to speaktorob.com. We'd love to book a no obligation consultation. Thank you for tuning in today, guys. We'll see you in the next video.